Friends, it's Brad. You know it, I usually know it, and I hope that those watching this channel today will hit the subscribe button so they can continue to know it. Now, our video today is all about some of the fresh ideas coming out of Washington, D.C. with the lending and mortgage and real estate world. Real estate has been trending sideways for the last 2 years. In some cities, it's going up. In some cities, it's going down. On the whole, going sideways. But our biggest issue is affordability. This video is all about some creative ideas the Trump administration is doing. Are they good? Are they bad? We'll find out. Right now, the conversation is just beginning. Nothing set in stone. Real estate is something most Americans aim to own, but unfortunately these days, due to mortgage cost, other issues, or other costs in their life, it's increasingly unaffordable. When we look back at the average median first-time homebuyer range going back to 1991, it was 25 years old. In 2020, it was 33, and now today, just 5 years later, it is nearly 40 years old. The reality is something has to change. However, the answers are universally not the same across the board. Let me give you a quick example. We want more inventory, but every state is different. In many states like Illinois and Pennsylvania and New York and many northern and western states, inventory is actually super low. Conversely, down south, especially in states with no state income tax like Tennessee, Texas, or Florida, our inventory has surged. Fun fact, the state with the most increase year-over-year inventory-wise in the last year, Tennessee. I think all the time about first-time homebuyers, and I worry for the folks coming in the generation after my generation. When we went to first buy, it wasn't exactly cheap, but it wasn't super expensive either. These days, if you don't have a parent or someone helping you out with a gift for a down payment, or you're not putting as little down as possible, it's almost impossible to buy. For instance, and right before we get into these ideas, when I was born in 1986, the average family median income, $24,000 a year, and the average single family home price, median, $83,000. Now, 2025, average median income, $82,000, and the price is roughly around $420. But that's for the nation. Locally in Middle Tennessee, the median is closer to the mid to low fives. So the reality is, it is tough to buy a home on a family budget these days. So with that in mind, all that aside, let's get into it. Here are 3 ideas the Trump administration is floating to hopefully get more affordability and get more homes on the market. So here are those 3 ideas: a 50-year mortgage, a portable mortgage, and a assumable mortgage. We'll go through all of them now. 50-year mortgage first. Now, this is something President Trump and his team loosely threw out there a few weeks ago and has quickly kind of backed off it. I think overall the feedback was not so good. When you look at the mortgage market, there are a vast majority of products, but the vast majority of people are using a 15 or 30-year conventional. Now, why was this not well received? Well, let's look at the average price of a home again. Take a $400,000 purchase, 30-year loan. If you tack on 20 years to that, the average monthly savings are around $200. Sounds great, right? Kinda, sorta. The downside is the interest that you would pay on that loan over the additional 20 years that have been added is roughly another $330,000. So on the whole, while you're saving a little bit month by month, it is a big additional cost. Conversely, with the average home median first-time home buyer age now being 40, if you had a 50-year loan, you're paying that bad boy off until you're 90. Now, I know most people aren't in their home for 50 years, but that's kind of the thoughts. And for all of those reasons, it's not a good idea. Next, portable mortgages. Honestly, I didn't even know this was a thing. This is a relatively new phenomenon here in America. In other countries, they kind of have a variation of it, but our lending rules are very different than those abroad. Here is the reality of it. If you were to sell a home, the whole idea is you could take your net proceeds, your equity, and your interest rate with you to the next home. So say you sell a home. Say you have net $300,000 that you're gonna get a check for, and you have a 3% interest rate. Essentially, you could take that to your next home. I do not think this is likely to happen. There's too many things. Our lending system, Fannie Mae, Freddie Mac rules, guidelines, it's just not set up to adjust to this. So what would that do for inventory, for affordability? Honestly, the answer is, I don't know. It is such a new idea that we really haven't gone down that street far enough to have even thought through it. So again, I don't think it happens. Lastly, assumable mortgages. Now, in principle, this is something you're able to do. In reality, unless you're a veteran getting a new home and taking over someone else's loan, it's almost impossible. Why is that? Okay, take a home purchase. Let's say the home you're buying has a 3% interest rate and you want that. I don't blame you. Well, a bank could originate a new loan to you today at 6%. So why should they do that? They're giving up the interest they could get on a 6% loan and giving it to you for 3%. So naturally, they are hesitant. Also, there is a clause in most mortgages, if not all, called a due on sale clause. What does that mean? A due on sale clause means that when the house with the mortgage is sold, the mortgage must be paid off immediately. Lastly, the other complicating factor is the guy or gal that got 3%, well, they got that because A, they timed it right, B, the underwriting standards for them allowed them to do so. You may not be someone the bank would feel comfortable with a 3% loan. You might be a nice guy or gal, but maybe you don't have the income, the credit score, the assets, all of the above. So for all of those reasons, banks are hesitant to give an assumable mortgage out, and I just don't know that that's going to become very practical either. Now, for my parting thoughts on it all, we kind of got two things going on here. Both are kind of two forces that are compounding against each other. On the one hand, for most Americans, the equity in their home is their biggest asset. And for that reason, we really need real estate to keep going up. On the other hand, I mentioned this earlier, I'm almost 40 years old. For the people coming behind me in their 30s and in their 20s, if we don't have a next few years of home prices that are relatively stable and maybe even drop some, I don't know how folks are going to be able to buy homes ever. Most people don't have parents that can give them down payments, and that pushes people into riskier mortgages. So what do? I think we incentivize more affordable housing, both apartments and homes. We incentivize more entry-level homes. We work with builders, with developers, with grants, whether that's by the state or feds, and we work to get more inventory on the whole. This will get first-time home buyers into homes. They'll get in the game. They'll then have equity to start growing, to go from a starter home to another home. Also, the capital gains rate has not changed on the sale of homes in nearly 30, probably 40 years. I'd have to look it up. So for instance, when you sell your home, the first $250,000 in capital gains are free if you're single. The first $500,000 are free if you're married. Sounds great, right? Well, in a world like Nashville, where we have over $500,000 as the median price, that doesn't go as far as it used to. It did in 1991, did in 2001, maybe even 2011, but in nearly 2026, we gotta up it. I say we go $500,000 for the first free if you're single and $1 million for the first free if you're married. That's it. I think that is the biggest solution. So as always, to hear about this solution or others, or just to work with me, reach out. As always, Think Nashville, Think Brad. We are here for you, so stay tuned, hit that subscribe button, and we would love to hear from you. See you soon. Cheers.